So Assalamualaikum and a very good afternoon to everyone. So my name is Muhammad Daniel Kuzairi bin Muhammad Nasir from Diploma in Investment Analysis from class JBA 1145K. So today I'm going to present to you guys about my topic, that is bond yield, and I'm going to focus more on types of yield and the yield curve and interest rates structure. Yield. So first of all, we need to know what is yield. So yield is a figure that shows the return that expressed in percentage that investor get on bonds. When investor buy a bond at par, yield is equal to the interest rates. When the price changes, so does the yield. So now we go to the types of yield. So basically, there are 4 types of yield. So now we go to the first one, that is current yield. So current yield is an investment's annual income, interest or dividend, divided by the current price of security. This measure examines the current price of a bond rather than looking at its face value. The second one, we go to the yield to maturity. So a bond's yield to maturity, or YTM, is the internal rate of return required for the present value of all the future cash flows of the bond, face value and coupon payments to equal the current bond price. So yield to maturity assumes that all coupon payments are reinvested at a yield equal to the yield to maturity and that the bond is held to maturity. So next one, we go to the yield to call. So the term yield to call refers to the return a bondholder receives if the security is held until the call date prior to its date of maturity. Yield to call is applied to callable bonds, which are securities that let bond investors redeem the bonds or the bond issuer to repurchase them early at the call price. And then the last one, we go to the capital gain yield. So capital gain yield is the percentage price appreciation on an investment. It is calculated as the increase in the price of an investment divided by its original acquisition cost. And now we go to the yield curve and interest rates structure. So what is the yield curve? Yield curve is a graphical representation of the interest rates on debt for a range of maturities. It shows the yield an investor is expecting to earn if he lends his money for a given period of time. The graph displays a bond's yield on the vertical axis and the time to maturity across the horizontal axis. The curve may take different shapes at different points in the economic cycle, but it is typically upward sloping. Please, we go to the interest rates structure. The term structure of interest rates is a comparison tool that plots the term length of investment securities against the amount of interest they pay. In economic circles, the term structure of interest rates is frequently referred to as a yield curve. So we go to the first one, that is normal yield curve. The most common shape for the curve and therefore is referred to as the normal curve. The normal yield curve reflects higher interest rates for 30-year bonds as opposed to 10-year bonds. If you think about it intuitively, if you are lending your money for a longer period of time, you expect to earn a higher compensation for that. So the next one, we go to the inverted yield curve. An inverted curve appears when long-term yield fall below short-term yields. An inverted yield curve occurs due to the perception of long-term investors that interest rates will decline in the future. This can happen for a number of reasons, but one of the main reasons is expectation of a decline in inflation. So then we go to the next one, that is flat yield curve. A flat curve happens when all maturities have similar yields. This means that the yield of a 10-year bond is essentially the same as that of a 30-year bond. A flattening of the yield curve usually occurs when there is a transition between the normal yield curve and the inverted yield curve. And I hope you guys understand everything that I present and also gain more knowledge from my presentation. So that's all from me. Thank you.